Hello and welcome to the Junior Achievement Stock Market Challenge. My name is Mark Wyand and I will be walking through some PowerPoint slides with you through two sessions to help prepare you for the main event, the Stock Market Challenge itself, which will be on March 1st. Over the course of these two webinars, we will cover the following topics. We'll talk a bit about stocks, what a stock is, and some basic understandings of how stocks work, what causes stock prices to increase and decrease, the fundamentals of the stock market, and finally we'll cover the basics of stock portfolio management. So how do you manage several stocks under one portfolio? Goals and objectives. Well, by the end of this, we hope you have a fundamental understanding about the concepts of stocks, understanding what makes the market as a whole tick, move up and down. We want to provide you with some knowledge and preparation for the Stock Market Challenge itself, which again is on March 1st. And we hope to establish a foundation to become a smarter, more informed investor in your lives ahead. And why does all of this matter? Why is it relevant to all of you? Well, the truth is that the stock market is an integral part of the economy, the world we live in. It's important for all of us to save and invest our money intelligently for future goals. And the reality is, again, whether or not you're directly involved with the stock market, whether you work in finance or not, you'll likely all be exposed to it in some direct or indirect way. That is, you at some point in your life will likely have an investment account to save for retirement. So that would be a 401k or a 403b through a company. You could also have an individual retirement account. Stocks would be in any sort of pension plan you are a participant of, college savings plans, any insurance policies you may own, and health savings accounts. So it's again a topic that will directly or indirectly affect us all through our lives. So we're going to kick off session one with a basic understanding of what stocks are, the differences between a private and a public company. We'll ask the question, well, why would any company decide to go public as opposed to being a privately held venture? And how does a private company actually go through the motions of becoming publicly traded? So what do we actually mean when we refer to a stock? Well, a stock is a unit of ownership of a publicly traded company. Those who purchase stocks or those units of ownership are called shareholders or stockholders. Traditionally, a stock is issued by the company and is represented by a certificate, a paper certificate, such as the one on the slide. However, in today's age, if you were to open a brokerage account, log online, purchase a share of a publicly traded company, say Google, those shares could be represented in digital form simply within your account, either that you see on your phone, your computer, or in a paper statement that you receive in the mail. So once you're an owner of that stock or or those shares, once you're a shareholder in that company, what does that mean? What benefits and rights do you have as a shareholder? In fact, shareholders of a company do not own the assets of a company, nor do they manage the day-to-day decision-making process within a company. Again, using the example of Apple, because you're a shareholder of Apple does not mean you have control over the equipment or offices of Apple, nor are you making decisions. That actually rests with the company itself. This is what's called the separation of ownership and control, and that is for the protection of both the investor as well as the company. As an example, if you were a shareholder of Apple and Apple went into bankruptcy, the bankruptcy court could never go after your personal assets as a way to reclaim funds. And the flip side of that would be the company is protected. Let's say a shareholder went bankrupt. Well, that shareholder does not have the right to seize company assets in order to recouped from bankruptcy. Again, this is called the separation of ownership and control. But what then does ownership of a stock provide you? Owning shares in a company's stock tends to give you three things. First, owning shares in a company gives the shareholder claim on the company's income and the right to receive a portion of the company's profits. If a company pays a portion of its profits to its shareholder, that's called a dividend, and we'll go into that more in a few minutes. Second, owning shares in a company frequently comes with voting rights. The voting rights give the shareholder influence in the direction of the company, primarily by giving shareholders the opportunity to vote on who's on the company's board of directors. The board of directors are responsible for increasing the value of the company and hiring and firing key managers like the CEO. Third, owning shares of a company comes with the right to sell your shares to someone else. So, as a publicly traded company, those shares are constantly bought and sold on the public market. And at an individual level, if you were to make a decision that you no longer wanted to own shares in a company such as Apple, it is your right and easily accomplished that you would go and sell those shares through your brokerage account, for example. Importantly, the more shares a shareholder owns, the more voting rights they have, and also the claims on the company's profit goes up. Again, there are both private and public companies. So far, I've used the example of Apple, and that is a publicly traded company. But the reality is there are many more private companies than there are public companies. When a company is first founded, the only shareholders are the founder, him or herself, and any early stage investors that provide money to start the business. During this stage, the company and its shares are considered private. Hence, a private company is typically owned by one or a few group of partners, although a private company could also be a corporation or a limited liability company, as long as the shares of the stock are privately held and not sold to the general public. If you were to think about the community you live in, most of the companies you see locally are private companies. So think of restaurants, professional services like doctors' offices, law firms. There can also be some very large private companies. Uber is an example that comes to mind. A publicly traded company is by contrast, one which shares of its stock can be bought or sold by anyone in the general public. Examples of publicly traded companies are Google, Apple, Starbucks, Coca-Cola, McDonald's. There are trade-offs between being a private and a public company. As a company grows and needs more capital to expand, one of the decisions a company's founder or partners need to make is whether to keep the company private or to take it public. There are a lot of pros and cons to consider. Advantages associated with staying a private company include the founders and partners retaining control over the future direction of the company. If a company chooses to go public, management loses some of its freedom to act without a board of director approval and the approval of a majority of shareholders in certain matters. For example, they don't need board or shareholder approval for operational and growth strategy decisions. Another advantage of staying private is that the company is not required to publicly disclose financial information. As a result, private companies can often prioritize and focus on longer-term growth better than if they were public. On the other hand, public companies must inform shareholders about financial performance and management actions, and shareholders might emphasize near-term profits instead. If you think about the market and the headlines we often hear, public companies report their earnings on a quarterly basis. So that's 4 times a year. They're scrutinized by shareholders as well as critics and pundits that are making commentary on the decision and the growth of the company. Being public also means that you're disclosing that information and you're sharing information with your competition. Another important consideration in choosing whether to stay private or become a public company is compliance with regulations and laws. In general, private companies face less regulation and rules than do public companies, and therefore going public tends to be more expensive, the costs of complying with all the regulations. There are a lot of benefits of being a public company. However, for example, as a private company continues to grow, there may be a point where the founders, partners, and early investors become eager to sell their shares to monetize their holdings in that company. And because private shares are not easily exchanged, and shares of public companies can be bought and sold by everyone in the general public, realizing the value of those shares becomes a lot easier when you have a public market. The company itself may need more investments to reach its potential than the founders or that small group of private investors can offer. So in this case, going public can make it a lot easier and make more sense because the company can raise a lot of money by selling shares to the public in order to expand or improve, purchase equipment, conduct research, anything that may lead to product or service improvement. In addition, companies that are public often have an easier time raising large amounts of capital later on because they are more transparent about their operations and performance, and their business becomes more well known and established. And this can cause that company to be perceived as less risky. So how does a private company actually become a public company? It goes through what's called an initial public offering, or an IPO. An IPO is the very first sale of new stock by a company to the general public. The transaction brings in new shareholders, so people that want to buy shares in that company, and the company receives a large influx of capital. The issuance of shares of an IPO dilutes ownership percentage of the existing shareholders' partners. So this reinforces the point made earlier that a disadvantage of being a public company is that the founders or partners need to share the profits of the company with more shareholders. However, existing shareholders establish a value to their stake in the company and going forward can more easily sell their shares. So in exchange for losing a percentage of your ownership in the company, you now have a liquid stake in that company. And if at any time you wanted to sell, walk away from the company, you could more easily do that. Now it's a publicly traded stock. Two types of stocks can be issued by the company through an IPO. One class of shares called common stock and another class called preferred stock. Common stock is the most popular type of stock. As noted earlier, common stock represents a claim on the profits, the dividends of a company, and frequently comes with voting rights to elect board of director members and to influence the strategy and decisions of management. However, dividends associated with common stock are not guaranteed and are paid out at the discretion of the board of directors. A lot of companies don't pay dividends at all. Most of the time, for example, tech companies, growth-oriented companies like Facebook, let's say, are still in a high growth mode. So they rather hold on to profits, reinvest in the company itself, rather than paying those dividends out to all the shareholders. Companies can issue different classes of common stock with different voting rights too. And lastly, in the event the company fails, goes bankrupt, and liquidates, common stockholders will not receive any of their investment back until creditors and preferred stockholders are paid first. Again, I mentioned that on the previous slide. If there are loans made to a company that need to be repaid in the event of bankruptcy, those loans have to be repaid first before stockholders see any of their money back. Preferred stock usually comes with a guaranteed fixed dividend, so a fixed payment, kind of like a bond, and that gets paid as long as those shares are outstanding, as long as those shares exist in the market. And in return for that, the preferred stock generally doesn't come with any voting rights, so that's the trade-off. Another advantage of preferred stock is that in the event of bankruptcy, preferred shareholders are paid before common stock shareholders. Preferred stock is also callable by the company, meaning the company has the option to buy back those shares from the shareholders at any time for any reason. So for the sake of our conversation, for the sake of the stock market challenge, when we talk about stock, we are primarily talking about common stock, not preferred. So let's make this real and look at a few examples of IPOs that have happened in the real market and what the subsequent results were of those IPOs or initial public offerings. First example, Dunkin' Donuts. They IPO'd on July 27th of 2011. It IPO'd or came onto the public market with an initial price of $19 a share, and that raised over $400 million for the company. By the end of the first trading day, the stock closed at $27.85. That's a 47% gain for those that either had stakes in the company prior to that day, or for those that were able to buy the first shares as they were initially sold to the market. By the end of 2013, the stock was above $45 a share. So a pretty good investment for anyone that wanted to become a shareholder in Dunkin' Donuts. The next example is Facebook, which IPO'd in May of 2012. At the time, the company had approximately 845 million users. It IPO'd at a share price of $38, which raised $16 billion of capital for Facebook. However, stock closed basically flat on its first day of trading at about $38.23 a share. 3 months later, the stock was trading for less than $20 a share. A lot of people panned this as a very unsuccessful IPO. As the shares traded down, the initial investors lost money, and it was thought that Facebook was really overvalued when it became a public company. That said, by the end of 2013, Facebook's stock was trading at over $55 a share, and the stock is currently trading around $137 a share today. Finally, Zynga, which IPO'd on December 16th, 2011. Zynga is an online developer of games such as Farmville. It had hundreds of millions of monthly users at the time of the IPO, and it was one of the fastest tech companies to ever earn over $1 billion in 1 year. The company launched with a lot of hype. The IPO price was $10 per share, and that raised $1 billion in new capital for that company. 7 months later, though, Zynga's stock was trading at just $3 per share. It's a 70% loss. So let's wrap up this first session by bringing it back to the stock market challenge. On March 1st, you'll be given the opportunity to buy a few IPOs during the competition. It will be up to you and your team to decide whether or not to invest in these IPOs. Some things that you as investors need to consider when deciding whether to invest in the IPO are: 1, does the company have a history of profitable operations? How likely is it to become more or less profitable in the future with more capital? 2, what is the company going to be using the money raised in the IPO for? Is it going to invest in operations, acquire other companies, pay off existing debts, reward employees and management? Some of these are more positive than others. 3, is the company going to be able to continue to grow? How many more customers can the company get? How big is the addressable market? Does the company need capital to offer more locations, invent new products, improve existing products, expand production, etc.? Number 4, can the company's position in the industry be defended from its competition? Is the company's product or service different and revolutionary? Can the product or service be easily copied? Number 5, is management up to the task of handling and running a larger company after the IPO? What is the reputation of management? And 6, are there other factors to consider when investing in an IPO?